Sure, you can watch the next 5-minute video about me talking about banks as financial intermediaries, but if you want to click here and skip straight to the end where there's a fun musical number, I won't blame you. Now, as financial intermediaries, banks provide the most liquid assets out of all the ones that we've seen. They act between lenders who want liquidity with their money and borrowers who want to not have to deal with the cost of doing stocks or bonds, and they just want flat loans from the bank. So the bank does this by using bank deposits. It is a claim from the lender for their money in the bank. Now, in this case, the lenders are you and me, any person who has their money in the bank. Now, in terms of the bank is also a lender because the bank takes that money to fund the illiquid assets of companies who are taking loans from that bank, or the borrowers from the bank. This would be companies looking to invest in new machines, a couple who just bought their first home, someone who's, myself, getting college loans. Anybody who needs money from the bank. Now, banks can't loan out all this money at once because in doing so, they would leave themselves no money to give to anyone who took a claim on their deposit accounts. However, if given the option, banks wouldn't keep any money on them because they'd spend all their money on their loans. This is why the Federal Reserve has required reserves in the reserve ratio. A great example of this is shown in T account charts.
Now there are a couple of things that's really important for you to notice about this T chart. Number one, notice how the assets are on the left and the liabilities are on the right. Credits on the left, debits on the right, as they say. In addition, notice how the left and the right sides are equal to each other. This is very important to remember, as with the saving investment theory that we talked about in the earlier video. Now, owner's equity over on the liability side is something that you can pretty much ignore. It's really just there to kind of balance the budget for us. The three really important things that you need to notice from this T chart are the deposits, the loans, and the reserves. Now, the deposits are all the money that lenders or customers of the bank have put into the bank. That is my money that went in the bank, your money that went in the bank, the local bakery's money that went in the bank. All of that is counted in those deposits right there. And at any given time, the bank is liable for all of those deposits. However, they don't keep all that cash around. So if all the cash isn't being kept in the bank, where exactly is it going? Well, that's what the loans section under assets is for. That's any loans that the bank has made to businesses, people buying houses, people buying cars, any of it. That all falls under loans. Now, we spoke about how the bank doesn't keep all of its money in the safe. However, keeping no money in the safe would be just almost as bad, correct? Because once someone demanded their money, the bank wouldn't be able to give it to them. Well, that's what the reserves are there for. The reserves are the money, both required and access reserves. It's made up of two parts that the bank keeps on hand, cash that the bank keeps on hand or keeps in the Fed's deposit. Remember, the Fed is the bank's bank, so it's basically at the account that your bank has with the Fed. And the Fed sets a reserve ratio. We're going to talk about this in a later video, of course, but that basically determines how much money the bank has to keep on hand, what percentage of their deposits they need to keep on hand to try to prevent a bank run. Now, bank runs are very commonly shown in movies, They don't happen very much anymore for reasons we're going to get into later. But I think the best way to demonstrate what a bank run is, I mean, I can tell you what it is. A bank run is just when everyone tries to take all their money out because they lose confidence in the bank. But I think the real value is going to come if you see an example of it.
Give it back! Give me back the money!
Michael, behave!
Give it
Michael, behave! Jane!
Give me
Jane!
back my money!
Jane!
Give me back my money!
There's something wrong. The bank won't give someone their money.
Well, I'm going to get mine. Come along, young man. Every penny in here.
And mine too.
And give me mine, too.
Stop all payments! Stop all payments!
Now, in today's modern 2018, do we actually have to be worried about bank runs? In reality, no, we don't. There are many different protections for depositors in the United States that make sure that even should a bank not be able to provide you your money immediately, you're not going to lose all of your assets. The biggest one of these is deposit insurance. Almost every bank in the United States is advertised as being a member of the FDIC, or the Federal Deposit Insurance Corporation. They basically provide deposit insurance, a guarantee that depositors will be paid even if the bank goes under. It's important to remember that this insurance doesn't protect depositors if the bank fails, but it eliminates the main reason for bank runs, that people are worried they won't get their money. People know they're going to get their money because FDIC is there for them, so there's no reason to worry and less risk of this type of run. Capital requirements are another way that the Fed ensures this, by making sure that any bank has more capital than their deposits, ensuring that should the bank go under, they have enough assets to sell off in order to make sure every depositor gets their money. Another way that the Fed does this is through reserve requirements, which we've spoken about already, and through the discount window. The discount window is kind of the Fed's final Hail Mary, if you will, for protecting the lenders, for protecting both banks and consumers, in that should the bank need additional money, they can actually take out their own loan with the Fed. As you'll remember from our video on the Fed, the Fed acts as your bank's bank. So any good or service that you would get from your bank, such as a loan, your bank can get from the Fed. This allows them to make sure that they can always have the money that they need should there be an over withdrawal from their reserve requirements on their account.